Yes. Hello, everybody. Welcome to our Social Security webinar. We're going to just take a minute or so here before we get started, just to let others join the broadcast, and then we'll go ahead and get started with today's really exciting conversation. So looking forward to it. Alrighty, yeah, people keep joining in. Wonderful. Welcome everybody who's just joining us. We're just going to wait a few more seconds here, and then we'll go ahead and get started. And then as we get things started up, do know that you can put questions in the Q&A box or in the chat bar as well, chat box, and then Chandran and myself will get to them. We will get to them as soon as we can throughout the presentation, and we will have a spot at the end for questions as well. All righty, Chandran, I think we're ready to go. People have joined in, so
hello, everybody.
Hello, yes, welcome to our Social Security webinar. My name is Edgar. I'm one of the wealth advisors here at Financial Freedom. And just a little bit about us, Financial Freedom Wealth Management Group was founded in 2001 by our current CEO, Julia Carlson. We are a comprehensive wealth management and planning firm committed to helping our clients improve their long-term success and pursue their version of financial freedom. Some of the people that we serve are retirees or individuals getting ready for retirement, business owners, and then people going through transitions. For example, the death of a loved one or even a divorce. We really want to make sure that we can serve those individuals as well. This is our wonderful team. We are 7 wealth advisors and 9 support staff. Not everybody is pictured here at this time. We just had 2 wonderful individuals join the team that are very excited and eager to help our clients and then anyone else that does business with our firm. But here's our wonderful team. And today I have the honor and privilege of being joined by Chandran Rajaratnam, President and Wealth Advisor here at Financial Freedom. A little bit about Chandran. He has 30 years of senior executive experience with IBM and Dell. He has a passion for helping others become leaders, which led him to write his book, Catch the Arrows. And he has been a Medicare specialist since 2008. So Chandran, it's a pleasure to be here with you.
Thank you, Edgar. It's a pleasure to be here with you as well. You say 30 years of experience. Some people could say I've had 1 year of experience 30 times over. So there's accumulation there. And I'm happy to introduce you, Edgar. You're a wealth advisor. You started with our company for almost 4 years ago as a client services advisor, and so you know both sides of how what the solution to our customers are, as well as all of the background as to make it happen. So you're actually twice as good as me. Whenever all I have to do something, and as my clients know, that things have to get done, I will turn it over to Edgar or some of our other team members because they do that. So welcome. I understand though that for all of the Oregonians on our website, I have to, full disclosure, he is not a duck. He is a beaver.
Go Beavs.
Graduated from Oregon State University. In our company, we have about an equal number, so we have an interesting fight going on as well.
Yes.
Anyway, welcome.
Well, thank you. All righty. Well, let's go ahead and get started, Chandran.
All right, let's talk about Social Security. When you talk about the history of Social Security, FDR started it in 1935. And here's an interesting piece of trivia. The first payment happened in January 1937. And it was a huge, anybody, Edgar, you want to guess how much the first payment was?
$100.
17 cents. You were close.
Yeah, very close.
It was a guy named Ernest Ackerman got 17 cents, the first payment. In January 1940, the first regular payment started, a lady named Mary Fuller, and she was 65 at the time, and she actually collected till she was 100. She passed away when she was 100. So that was the first time. And then the only other part of the history I'll tell you is in 1975, they started adjusting Social Security payments for inflation. And in most years, that's been a pretty paltry sum. I think there was one year it was like 0.2%. However, this year, all Social Security recipients won out because they picked the third quarter of a year to compare with the previous year. And this year, third quarter had a 5.6% increase over the previous year. So our Social Security payments went up by that. Just as an aside, unfortunately, they put up Medicare Part B payments too. So some of that was taken away, but it was still a net plus for us all. Now, one of the key factors, you might have heard some news about Social Security, whether it's going to run out of money, all that stuff. Well, in 1945, there were 50 people contributing for one person taking money out. And you can see the numbers here. As of 2030, they expect only 2 people contributing for one person taking money out. And the way the fund works is that as we work, we pay our taxes, Social Security taxes that goes into the fund, and it grows over time. It's invested and grows over time, and then they pull it out. Now, the worst case scenario, if you heard some of the news and some of the drama out there, by 2033, that fund actually runs out. The buildup of funds runs out. And then only 70% of the money that's going out is funded by the money that's coming in. So if you want to believe the worst case scenario, then our Social Security payments will drop to 70% of what they are today, or what they will be by 2029. However, in 2033, all it takes between now and then, we have 11 years for the government to put a 0.1% increase in the tax, and that funds Social Security till somewhere in the 2080s. So Edgar, I'm pretty sure they'll do that. And so for me, hey, that takes care of me. I don't know about you. Yeah, you're a few years younger than me, like about half a century. And so when 2080 comes, you and your generation got to solve this problem. All right. The people watching, most of us are in our later stages of life, or the second half of our life, so we'll be just fine. So that's one of the things to take care of. So I think we'll be fine going forward on that. Next slide, if you would. Thank you. Now, one of the problems with Social Security is people who are dependent on it for their retirement earnings. Now, source of retirement income, typically Social Security is about a third, and pensions, asset income earnings are about 2/3 of retirement. That doesn't tell the whole story. That takes care of the overall average, overall people in the country. However, in 2019, the study was done that showed that the average American had approximately $65,000 in Social Security or in retirement funds put away for their retirement. So 65,000 is, if you think about it, if you're 65 and you're going to live 30 more years, it's not very much. So for a lot of people in the United States, Social Security is the main focus or the main source of income for retirement. And what's interesting is that in 2013, it was also 65,000. So it hasn't gone up very much, even though the value of money has gotten less. It's still staying around $65,000. So that's something to take care of we encourage people to save for retirement outside of the Social Security that they have, in order to make sure they have enough. But that's why it's also important that Social Security be viable and keep doing it, because at least it does provide a base for most people. Now let's get to the details of Social Security. Now, the people eligible for Social Security are, as you see here, retired workers, spousal, and survivor. And we'll talk about all three of those. How your benefits are calculated is they look at 40 quarters of work to give you credit for Social Security, and then 35 of your highest earning work years. Now, as far as the 40 quarters, how is a quarter defined? is defined as earnings of $1,510 per quarter. So it's divided as 3 months and $1,510. If you make $1,510 in that, you get credit for that quarter of work. Now, in reality, it sounds like every 3 months they're going to check you out. They don't. They go back to the previous year. At the end of the year, they look back. And technically, if you have $6,040 of earnings, you get 4 quarters of credit. Now, you could have made all of that in January and February and nothing else after that, you still get 4 quarters of credit. So, but the number is 1,510 per quarter or 60/40 per year, right? And then the 35 highest earnings years is if you work for 40 years, they'll take the 35 of the highest one. Now, if there were 4 or 5 years that you left the workforce for whatever reason, you went on a sabbatical, you took pregnancy leave, whatever that is, then there will be zeros in those years. But as you keep working, those zeros will be filled in. It'll still be 35 of your highest years. And what's interesting is that usually the first year you had was you maybe had just had a 6,000, 60/40 type of job or whatever it was back then. And then now you're making a lot more. So every time you work 1 more year, they eliminate the lowest one and they add the new one. So it benefits everybody for as long as people want to stay working. Now, as far as when full retirement age, and that becomes a key factor to talk about in a minute, when full retirement age is defined, it used to be 66 years. So if you're born between 1943 and 1954, at 66, you achieve what's called full retirement age and the base full amount of the Social Security that you're eligible for. They changed that to 67, and they did a sliding scale for people born between 1954 and 1960. So now people that are turning 62, 1960, they're turning 62 this year. So they can take the Social Security reduced amount, but for them, it's 67 is their full retirement age going forward. And then I'll show you on the next chart how this works. So at 62, you can, even though your full retirement age may be, we're assuming, let's say 66 or 67, at 62, you can take Social Security. That's your earliest eligibility for benefits. Unless you're disabled, you can do it differently if you're disabled. And then your benefits are reduced by 25 or 30%. Again, if you're 66, then it's 25%, and if your retirement age is 67, it's 30%. And it's permanent reduction. You lose that amount, and you get the lower amount for the rest of your life. At full retirement age, you get it all. And then after full retirement age, they will keep increasing your benefits. So if you wait till 70, which is the maximum, you will get 8% a year past your full retirement age more in your account. I'll give you an example of how that works. So here are the two scales. Why at 25% is that if you're at 66, then at 62, you will lose 25% of that. And if you're at 67 is your full retirement age, then it's 30%. So this is kind of how the different numbers work. So the question that comes up a lot of people is, well, so when should I take it? Should I wait? Should I take it early? And so that's one of the questions we get asked a lot by our clients. So here's how it works. We recommend taking Social Security as soon as you quit work, after 62. And I'll tell you why in a minute. If you get to what happens at 62 is, actually, if you go back to the previous slide for a second. The reason we say only after you quit work, if you take Social Security at 62 and you're still working and you make more than $19,560 a year, they will then take back $1 for every $2 you made more than $19,560. And that's not very nice, because afterwards they send you a bill and now you got to pay it back or make payments or whatever that is. So it doesn't make sense if you're going to make more than 19,560 to take Social Security at 62. There are a lot of Americans, I think the majority of Americans actually take Social Security at 62, but hopefully they've figured out that they're not going to be, they're going to be either part-time workers or not working at all, and therefore this 19,560 or clawback provision doesn't apply. There's a minor quirk there. If, let's assume, you reach full retirement age in July of a particular year, that if you're 67 in July, that year between January and July, you can make 51,960 and not have anything taken back. So most people, if you're going to take Social Security, you could take it in January 1st of the year that you turn full retirement age, because the chances you'll make 51,960 between then and your birthday is relatively low. I have no idea why they made it that complex. I was thinking that maybe when they designed this thing, the guys in the basement of the whatever government building said, this is too simple to tell them, hey, we'll just give you this much when you turn 65. Let's see if we can make it complex. Also, it provided a whole bunch of work for thousands of people since 1935 until today. I'm being facetious, but it does. Some of these things are beyond explanation. So now, after full retirement age, you can go back and work as much and make as much money as you want. It does not affect what you will receive from Social Security. Now, the reason we tell you to take it early is, let me show you this particular example. Let's assume your full retirement age is 66. In this chart, you'll see you get $1,866 a month for the rest of your life, plus increases for inflation. Now, a lot of people, a lot of calculators that are out there, and even Social Security would say to you, why don't you wait till 70 to take it, because you'll get $2,463 instead of the $1,866. Right? Makes sense, and especially if you're going to live a long time, that's going to be to your benefit, because then you'll get more money for a longer period of time. Right? The one problem with that type of logic is it doesn't take into account the value of money. So let's assume that you are at full retirement age of 66, and whether you're working or not, let's say you're still working, so you don't really need the Social Security money, and you plan to take it at 70. We would tell you, take the 1866, and since you don't need it, invest it in long-term equities or stock portfolios, like the ones we have. Now, long-term stock portfolios are averaged over the last 100 years, 10% per year, right, compounded. So let's use 9% as an example after fees and everything. Let's assume you got 9%. If you take the 1866 and put it away in a retirement account, when you hit 70, you would have $107,300 in your retirement account, in that special investment account. Now, the difference that you lose between 1866 and 2463 is around $600. It's actually $597. Now, $107,000 in an investment account would only have to earn 6% per year, actually 5.9% per year, to make up the difference between 1866 and 2463. So you would be getting 2463 by taking the 1866 from Social Security and $597 or whatever that number is from your investment account. At the end of your life, you would have gotten all the money you should have gotten from Social Security, and you still have an account that's got $100,000 in it to pass on to your beneficiaries, et cetera. So when you input the value of money and what money can make for you into the equation, it changes the way you look at it. Same thing would happen if we had talked about 62. But from 62 going forward, the same logic applies. Now, none of these are, unfortunately, I can't tell you they're guaranteed. I could just go backwards and tell you that the stock market averaged 10% per year. But we could use any different assumptions, but the principle is still the same, where if you put the value of money on, it changes changes the thought process than just a simple calculation. Plus, the other thing is what happens if you don't live. You thought you lived till 95, but it only worked till 87. Then if you had known that, you would have made a different decision. So anyway, we're happy to talk individually for people and using whatever assumptions we want to use going forward, because they are just assumptions, but they're valid. The principle is still valid.
Yes. So spousal benefits. There are two things that I want to spend some time going over today. There's spousal benefits, and then there's survivor benefits. So let's go ahead and begin with spousal. Two important things about spousal benefit. One, it can start as early as age 62, and the calculation of your spousal benefit does not depend on when the primary worker takes their Social Security. So with that being said, when can spousal benefits be taken? And that is when the primary worker is still alive and has applied for Social Security benefits. If you are age 62, then you are eligible to apply for that spousal benefit, but it will be at a reduced rate. If you decide to wait until your full retirement age, then you're eligible for the maximum spousal benefit, which is 50% of the primary worker's full retirement benefit. 50% of the full retirement benefit, yes. And then there's a survivor benefit. This one actually starts a little bit earlier. It starts at age 60. And this one actually does depend on when the primary worker took Social Security, because depending when they took it, it will determine what number is used to calculate said benefit. So when does the survivor benefit come into play? That is when the primary worker is no longer living and you are at least age 60. If you decide to take a survivor benefit at age 60, it will be reduced, but you are eligible for the full benefit at your full retirement age, which is 100% of the deceased primary worker's Social Security benefit. So we have two different things at play here, and sometimes talking about them like this isn't how I like to learn. So let's actually use a visual case study. So in this situation, we have Jack and Diane. Jack is the higher earner, and Diane's retirement benefits are less than the spousal benefits. And then we have Jack's annual Social Security benefits listed here. The $10,000 is just something that we picked to make the math easy. It is not a good representation of average Social Security benefits, but this is just for illustration purposes. And we're assuming that each of them's full retirement age is 66. So what are Diane's maximum and minimum spousal benefits? So assuming that Jack took retirement at age 66, full retirement age, if Diane wants to claim spousal benefits, how much would she get? So I'll give a moment here for the chat box. If anybody has an idea of what she would get, go ahead and put that down there. Alrighty, if you said $5,000, you are correct. $5,000. And the reason is spousal benefits only depend on the primary worker's full retirement benefit, which in this case is $10,000. But let's say Diane decided to take the spousal benefit at age 62. What would she be eligible for as a maximum benefit? We had two right answers in the chat. That's awesome. So can we get this next one? $3,750. Because Diane decided to take the spousal benefit prior to her full retirement, it was reduced by that 25% that Chandran mentioned earlier because of her early claim at the benefit. So the same could be said if Jack waited until age 70. It wouldn't change the maximum because it's pegged to the full retirement age of Jack. It just depends on when Diane decides to take it, whether it will be reduced or not, and by how much. But then we also have the survivor benefit. This is the one that can start at age 60 but it is dependent on when Jack took Social Security. So the numbers have shifted a little bit in this situation. We went with the full retirement age. Jack would get $26,000, which is the average Social Security benefit at full retirement age for men in the United States. So if if the Social Security was taken at age 62, Diane would only be eligible for a maximum benefit of $21,500. But if we had waited until age 70 after getting those 8% increases, $34,000 per year would have been the spousal benefit. So that's about a difference of about $12,500 per year. And I know that can make a big difference for a lot of different people. So deciding when to take Social Security should be a carefully examined situation, because even though there is the spousal benefit at play, we need to keep in mind the survivorship benefit and take care of your long-term future.
So Edgar, you're kind of saying that if let's assume the primary is quite a bit older than the spouse, then waiting till later will allow the spouse to get much higher survivor's benefit, assuming that the primary is going to die quite a bit sooner than the spouse. So those are the types of situations to take a look at. Yes. Also, I noticed in what you said that the spousal benefit will go up to half, but doesn't go up there's no advantage for the spouse to wait till 70 to try to get the increase, right? That doesn't work. It's just the maximum is half of the primary workers benefit, and it could be lower if they take it at 62. So
yes, yeah, and it's also important to point out that the spousal benefit needs to be higher than your benefit as well. You will get the higher of either of the two, and it happens automatically as well. Social Security will make that happen. Okay. Yes.
All right. So the next point would be an interesting one, which is it's again back to those people sitting in the basement of the government building. They decided to have some fun with this one. So divorcee benefits available if a marriage lasted 10 plus consecutive years. So let me give you this one scenario. If a 20-year-old got married and in 10 years divorced that person, let's assume the male is the 20-year-old, and when he's 30 he remarries, and when he's 10 years later he divorces, and when he's 40 he remarries, etc., and at 50 he divorces, and at 50 he remarries 60. So he has what, 4 or 5 ex-wives. As those ex-wives don't get married again, they can all claim spousal benefits off of this one person's record. I wouldn't recommend doing that. Usually somebody with 5 ex-wives has got more troubles than you can think about. So, but the requirements for divorcee benefits is if the marriage lasted 10 plus consecutive years. Now, the key thing is that in order to get monies off your ex, the record, you must not be remarried, at least until you're 60. So again, somebody likes to make this complex. So until you're 60, if you're not remarried, you can start taking at your full retirement age, you can all take spousal benefits if you're not remarried. After age 60, you can be remarried and get some benefit. So, and if you work, you receive the greater of your retirement or the spousal or survivor benefit off the ex. It is subject to the earnings test until your full retirement age, back to that same issue about $19,560, including the money you get from that excess record, the Social Security you get from the excess record. Now, if you go to the next slide. Now, if your former spouse remarries, it does not affect your benefits, does not dilute your benefits at all. If you remarry before 60, you forfeit your spousal benefit off X. If you remarry after 60, you forfeit and keep survivor's benefit of X. One thing though is that if you do remarry, but then that marriage fails, you can go back and claim from your first ex-spouse as well. So in other words, this is really complex, but if you're divorcee, come see us. Right, we'll work individual case and let you know exactly what your rates are and how much you can do that. And this is something a lot of people miss. They don't, they were married somebody a long time ago, and he could have done really well and have a huge Social Security number. And if you don't keep track of it, and he doesn't have to agree, by the way, it doesn't affect what he gets. Right now that you're over 60 or you're 66, you could go back and look, oh, his is a lot more than mine. And we're not talking 50% of his, we're talking all of his is a lot more than mine, especially since if he's passed, you get all of his as well instead of yours. So it's just something to keep track of on your own particular situation. Now, there's another thing you might notice if you look at it, it's a small complexity. A spouse and children get to claim off of an individual Social Security record. Minor children under 18 are people who are in school, in high school, until they graduate or 19 is the rule there. Can get Social Security benefits, and those minor children can be stepchildren, adopted children, and grandchildren, whatever the case is, so that they're related to the original owner. In addition to disabled children, all of that together cannot be more than 150 to 188, depending on when they took it, off a primary worker's monthly benefit payment. So they kind of limit that. Now, it doesn't apply to spouses. The two people, it doesn't. There's no application there. Right. And also it doesn't apply to divorcees. It's just if you're in a household, and that's many times in my case, I did have a stepchild with me who was under 18, and after I turned 62, and there were two payments made, one for me as well as one for the stepchild. So that's something called, again, one more little piece of complexity. Edgar, we've been paying Social Security taxes all our lives, as you know. Don't tell me the government wants to tax that.
They will try. So let's go ahead and get into that. So will your Social Security benefit be taxed? And the lovely answer is maybe. So let's take a look at that. If you're single and taking Social Security and you make less than $25,000 per year, your Social Security benefit is not taxable. If you're a couple that does their taxes married, filing jointly, that number bumps up to $32,000 per year. But once you start making even $1 over that, your Social Security benefit can be taxed up to 85%. 85% of your benefit could be taxed. And you start hitting that 85% for single people once you make over $34,001. And for couples that do married filing jointly tax returns, $44,001 as stated here on the chart. But one of the most common questions that we get is, well, what determines this income? Is there a calculator or a equation somewhere? The answer is yes, there is. It's right here. So it is your adjusted gross income, which can be found on your tax return, plus tax exempt income. So in this situation, I think of municipal bond interest, for example, things that should be tax-free. They're actually added back in, and then half of your Social Security benefit. That together is called your combined income, and that is what the IRS looks at. But there are certain things that are excluded from this calculation. One of the most important things people should be aware of is Roth IRAs and Roth 401k and 403b distributions are not considered income for Social Security taxation. They are excluded. So if you have Roth IRAs in retirement, it may be worth taking a look whether you should take distributions from those so that your Social Security benefit isn't taxed. There are a few other things as listed here, inheritances and gifts that you receive. Qualified charitable distributions are also excluded from this calculation as well. This is not a comprehensive list, but these are some very common things that people have that we wanted to share with you. So they will try to tax you, but there are some ways and certain things that actually do not add to that calculation. So what happens next? All right, so I have a little bit of homework for everybody in attendance. So I would encourage all of you to go to ssa.gov and create your Social Security profile. It doesn't matter if you're young or you're getting ready to retire, you should go to this website, get your profile ready, and I would do an audit of your earnings history. So your earnings records actually get posted on this website. And it's important that if you earned X amount of dollars, that it is reflected appropriately so that your Social Security is counted correctly. I would encourage you guys to find the following three things: your Social Security estimates for age 62, your full retirement age, and even age 70. So just a little bit of homework there for all of you in attendance. And complimentary consultation. So as part of this webinar, we are offering complimentary consultations to anyone who wants to text SSI to the phone number listed, 458-777-4458. Again, SSI to 458-777-4458. And if you have a particular situation that you want to go over with one of our wealth advisors, we welcome that you create this consultation and we just have that conversation. And I know we have some questions that came in throughout the presentation, so we will try to get to those here in a moment. And this slide here is all about LPL Financial. They are the broker dealer that we partner with to provide investment services. They are the largest independent broker dealer. And one of the things that we love about them is that they have no proprietary products. So there is no LPL Financial funds that we try to sell to our clients. We have access to a wide variety of investments through them. And on that note, thank you all so much. And let's go ahead and take questions while I go over to the disclosures page.
All right, so I've got a couple here. Thank you, Edgar. So back on that conversation about taking Social Security earlier, one of our visitors said, claiming early before 70 only works if you don't spend the money and just invest it, which isn't usually what happens. So most financial FPS advisors told them to wait until 70 if possible. A couple of things on that. You're right. If you're going to spend that much more than you were going to spend anyway because you take a Social Security, it doesn't work. But that's true of any sort of expenditure. Many times what happens here is that if you take the Social Security, you're then not taking money out of your retirement funds, which allowing them to grow in whatever investment they're in. But you're 100% right. You got to be disciplined that this is extra money that you're going to put away. Otherwise, that doesn't work. The only other reason I recommend taking it before 70 is you don't know how long you're going to live. So if something happens, you wait till 70 and you pass at 75, gee, you could have been taking it since 62 and have more money to let somebody else. But discipline is important. We had a couple of questions. Sorry, Edgar, do you have something?
Yeah, I just saw one come in real quick. I'll answer it really quickly. Can we just explain the survivor benefit once more? Absolutely. So survivor benefits can be taken once you turn age 62. You can take a survivor benefit and it will be reduced depending on when your full retirement age is. And the survivor benefit is 50% of the primary earner's full Social Security benefit. So hypothetically, let's say that you had $1,000 a month that the primary earner had at full retirement age that they would be eligible for Social Security. If you claim spousal benefits, you are entitled to half of that plus, or I guess minus any reductions, depending if you take it early for yourself. But it only will apply if the spousal benefit calculation is higher than your benefit, depending on the time you're going to take it. So there's a few things at play here, but you can get up to 50% of the primary earner's full retirement benefit as a spousal benefit.
Right. And then there was a follow-up question. Can you do both survivor and spousal? Again, it's whichever is higher that you can get it. No, so you can't collect both.
No.
There's a question about the common law as far as the 10-year marriage about claiming off your ex. Common law is fine as long as you meet the requirements of the state's common law laws as being married. So if the state that you live in says if you, there's certain things you got to go through, certain rules that says, yes, you are married on a common law, then everything that we talked about applies. And then the follow-up question, what do you need to know about your ex? You actually need his social security number, and you also need the marriage and divorce certificates, copies of that in order to prove the 10-year marriage, as well as the fact that you were married and whose number you claimed from. The ex does not have to know anything else at all, and will never know whether you're taking money off Social Security off of his record or not. Let's see, and please contact us. This one person wants to know if we can work with you. Happy to help anybody with this, whether your clients or not. Whoever's on here, we'd be happy to help you.
Yeah, Social Security has a lot of moving pieces, spousal benefit, survivorship benefit, all kinds of things going on. So our wealth advisors are well equipped to help you with your situation. And we would invite anyone to schedule that complimentary consultation to go over the specific details of your scenario. So I don't see any more questions. Chandran, do you have anything on your end?
No, I think we've answered all the questions. If you think of anything afterwards, please let us know. We'd be happy to help you. The goal here is, all your life you'll be paying the Social Security tax. Let's make sure that you maximize the benefits you're supposed to receive, and not leave a penny on the table. It's yours, and so we'd like to help you maximize that.
Okay. Wonderful. And yes, there's nothing left in the Q&A box, in the chat box. So everybody that was with us, thank you so much for your time. Take care.
Thank you. All right. Be well, be safe. Take care. Bye.
Bye-bye.